After almost 2 weeks of delays, the Social Security Administration announced changes to Social Security for 2026. Those changes will affect both people who are receiving Social Security and those that are approaching the age to claim Social Security. And this is what we're going to talk about next on Holy Schmidt.
Holy Schmidt!
Every year in mid-October or in 2025, late October, the Social Security Administration announces the changes to Social Security for 2026. This video is going to cover 5 of the most important changes for 2026. All right, let's get into it. Change number 1, the cost of living adjustment, or COLA. In 2026, that number is 2.8%, up from 2.5% in 2025. Now, I'm a bit mixed on this one because the cost of living adjustment year over year actually went up, which is a good thing in theory for retirees, but it went up because inflation is higher by 2.8% on average. So that's not a good thing for retirees. And most retirees don't pay for their expenses just with Social Security. They pay for their expenses with Social Security, pensions, annuities, savings, and investments. So that means that if they're not receiving a 2.8% increase in the other cash flow items on their balance sheet, they could end up behind in 2026. The other reason 2.8% is not necessarily good news is that it's not broken down by individual component. For example, energy went up as high as 11.7%. And so if you spend a lot of money on energy, and people who live in, say, the northern part of the United States spend a lot of money on things like heating oil and natural gas, then you might feel like that number is a little light compared to your particular spending. It's also not regionalized. So if you live in a place like New York, for example, you might see bigger increases in certain items that people who live in Florida won't see, and vice versa. But overall, it's less than 3%. 3% is a number that are used in a lot of financial planning models as the inflation target. So being slightly under target, I suppose, is a good thing. So that's what's coming in. On the other side of the equation, the 2025 Social Security Trustee Report says that Medicare Part B is increasing to $206.50. That's what the projected number is going to be, and that's a huge increase over the prior year. So it's much larger than the cost of living adjustment. In fact, it's an 11.6% increase, or $21.60, which represents the largest increase since 2022. According to the SSA, the average Social Security payment is going up by $56. So even though there's an offset there, certainly isn't the only thing that has gone up in a retiree's life. We're in the annual enrollment period with Medicare. What that means is between now and December 7th, if you want to make changes to your Medicare plan, now is the time to do it. In fact, there was an article in the Wall Street Journal about a week and a half ago that said 1.2 million Medicare Advantage plans are going to be canceled. And whether you're among that group or not, the article also said that the prices of Medicare Advantage plans are going way up, at least in many cases. So it's worth it to check it out. And we recommend our partner chapter. Give them a call at 440-703-1224. It's completely free to you, and they save their clients an average of about $1,100 per year. Next up, the wage cap. It's going from $176,100 to $184,500. Now, frankly, because of the amounts we're talking about, this won't affect a lot of people. $184,500 is more than most people earn per year. But if you're lucky enough to be in that category, that means that anything you earn in excess of $184,500, you don't pay Social Security tax on. So who is this good for? Well, first of all, if you're receiving Social Security, it's good for you because that means that the taxable income of the more affluent goes up, which means that more goes into the Social Security Trust for payment out to Social Security recipients. But it's not good for people who make under $184,500 because that means the threshold has gone up. So if you're close, you're going to be paying more taxes in 2026 on Social Security. So the ultra-high earners are going to contribute $11,439 to Social Security, and their employer is going to match that for a total of just under $23,000. Next, what I call the Great Equalizer, Social Security bend points. Now, when you receive your Social Security payment, it's not just an arbitrary number. They don't just look at your earnings and say, we should pay you about this much. They have a very specific formula on what you should receive at full retirement age. That number is determined using a formula called bend points. Now, bend points effectively take your historical earnings, indexed to today's dollars, adds them all up, takes your best 35 years, divides that by 420, and then that number is what's used to determine your Social Security payment. But you need to do one other thing with that number, and that is feed it into the formula for bend points. Now, if you file for Social Security in 2026, and this is your full retirement age year, the Social Security Administration will give you 90% of your first $1,286 in average indexed monthly earnings. That's your 35 years divided by 420 months. What's the average? They'll give you 32% of any amounts above that, $1,286, all the way up to $7,749. And they'll give you 15% of any amount over $7,749. That's how your Social Security payment is calculated. That's a very simplistic way of describing it. But just know this, the amounts that you're going to receive have gone up simply because the thresholds have been increased. If you haven't filed for Social Security, that is. And the reason I call it the Great Equalizer is that even though you pay taxes up to $184,500, Social Security taxes, 6.2% with an employer match, because of the bend point formula, the amount that you receive goes down the closer and closer you get to that cap. What this basically means is that if you earn the maximum and you make the maximum contribution, you contribute over 11 times more than the first rung, but you only get 3.65 times more in Social Security payment. Again, I just released my 2026 Social Security Quick Guide to help you make sense of all of the information we're talking about and we will continue to talk about in just a couple of minutes. So if you want a free copy, it's absolutely free to you. Go to my website, hollyschmidt.com/quick guide, and you can download your Social Security Quick Guide, which has everything we're talking about in this video and a lot more, all on one page. Next up, the earnings limit. This applies to you if you started to collect Social Security and you continue to work and you receive an income. Let me explain how this works because this is really important. The Social Security Administration has a provision in Social Security that says if you draw Social Security, you can only earn a certain amount. Otherwise, you go over what's called an earnings limit. And that earnings limit is basically set at a level where it's very difficult to earn a full income and continue to collect Social Security, at least for most people. So if you're working and collecting Social Security, and this is not your full retirement age year, that earnings limit in 2026 is $24,480. Anything above $24,480, you need to give back $1 for every $2 over that limit. If 2026 is the year that you reach full retirement age, but you haven't reached full retirement age yet, so this is your full retirement age year, and you're working and you collect Social Security, you can earn up to $65,160, and any amount over that, you have to give back $1 for every $3 over that threshold. Once you reach full retirement age, and in 2026 and beyond, that's age 67, you can earn as much as you want, and you don't have to give back any of it to the SSA. Now, a very common question is asked at this point, what happens to the money that I return to the SSA? Do I get it back? Yes, the SSA recalculates your payment at full retirement age and increases your payment based on the amount that you've given back to the Social Security Administration. If you find yourself in the situation where you've started collecting Social Security and you weren't planning on going back to work, but now because of an opportunity that's come to you, you're working again, the best move here is to let the Social Security Administration know early and tell them that you want them to stop sending you or reduce the size of your Social Security payment to correspond with the amount that you're earning. You don't want to be in a situation in 1 or 2 or 3 years where they figure it out on their own, because they do work with the IRS, obviously, and they send you a bill for $20,000, $30,000, $40,000 or more. Next up, work credits. Now, work credits I call the ticket to the game, meaning if you don't have a certain minimum amount of earnings, you can't collect Social Security, no matter how much you earn. You could earn a lot of money. You could max out your Social Security for the first 9 years of your life and then stop working and never collect Social Security, even though you've contributed more to Social Security than your neighbor next door who earned a modest income and worked for, say, 35 years. So it's important to understand how this works. And by the way, the individuals this happens to most are parents that have children. A lot of times they have great careers and they decide to stay home. And maybe their intention is to go back to work, but they never go back to work. And they've contributed a lot of money to Social Security. They're big earners. Maybe they were lawyers. Maybe they were bankers, doctors. I don't know. But after 8 years, maybe even 9 years, they say, you know what? This is it. I'm done. I'll come back later. Maybe. So what is a work credit? Well, it's an amount that you earn that's reported to the IRS in income. And it's a small enough number that it's really hard to miss unless you don't really plan for it. You're not paying attention to it. Let me explain what I mean. In 2026, the threshold is $1,890. If you earn $1,890 in one quarter, you get one work credit. Now, you need 40 work credits. For most people, that means 10 years in order to qualify. But if you are a big earner, you don't have to wait until the next quarter to earn your next $1,890. You could earn it all. You could earn all 4 credits in one quarter. You could earn it in a month, really, if you earn the maximum for the year. You just can't earn less than $1,890 in a quarter and still get one credit. So $1,890 times 4, that's $7,560. If you earn that in 2 months, 3 months, 4 months, you've covered that year's 4 credits, but you can only get a maximum of 4 credits per year. What this means in practicality is that you need at least 9 years and a certain number of months of work history. Call it 10 years for most people, just to make sure that you actually hit the number. I suppose theoretically you could work 9 years in 1 month if you had a month in your 10th year that was $7,560 or more. But the important point to remember here, and I can't overemphasize this, this is one of the easiest aspects of Social Security to miss. It's also one of the easiest aspects to fix, because even if you go back to work part-time, you can pick up any remaining work credits most of the time. So if you were that stay-at-home dad or the stay-at-home mom and you have 8.5 years of work credits, well, if you get a part-time job that pays more than $1,890 per quarter, then you can cover off the remaining time pretty quickly. But you do need to know that this is an issue. And you can actually check your Social Security statement on the Social Security website, ssa.gov, to see how many work credits you have. So this is really, really important. And the last point, full retirement age. In 2026, that's age 67. What's important about this, though, is that every year for a number of years, it's gone up 2 months per year. Last year, 2025, it was 66 years and 10 months. In 2024, it was 66 years and 8 months. But it stops in 2026. It does not continue to go up. It stops at age 67. So if you reach full retirement age in 2026 or later, your full retirement age is age 67. As a reminder, if you have questions about Medicare, give our partner at Chapter a call at 440-703-1224 to see if they can help you. If you like this video, check out that video, how to pay 0 taxes on Social Security. This is Jeff Schmidt, and I will see you in that video right there.